Last week I confessed that I didn't know what was going on, and now I'm overtaken by overconfidence and feel as though I know what's going on, but nobody else does. Long-term interest rates in the States and all over the world broke to new lows this week. That's on with a companion data pattern of about everything you can measure in the United States actually hitting a new phase. And my primary argument with U.S. data and interpretation of U.S. data has been, it's okay, but there's no acceleration. Now there's an acceleration. Some of the most important things to me that I've watched, there's a National Federation of Independent Business which surveys small business people. And it's been a grim thing to look at ever since 2007, and now it's not. It's out. Another one that a retired economist at Northern Trust, Paul Casriel, has said, watch total bank credit. Just watch it. And a year ago now, he said total bank credit is growing at about a 9% annual rate, and it means we're going to have a good 2014. And the total bank credit was growing at a 9% slope straight through the summer, and then all of a sudden downshifted in October, fell in half, was barely positive. November, 14% growth. We're short of incomes, the housing market is still flat, and it's very painful for me to change my mind. But the preponderance of data says that the U.S. economy took a step up, and not just a temporary one, but took a step up overall. And in companion with the step up, there are fewer headwinds out there, and there are fewer things that are likely to go wrong domestically. Now, against that backdrop, the Fed's got to do something. The Fed's got to come up off zero. The Fed's not just in the inflation fighting business, the Fed's also in the bubble fighting business. And staying at zero is a dangerous thing to do unless there's very good reason to stay at zero. It is worth tossing a quarter point, as I wrote, I think, last week. Just toss a grenade over the wall to see if, make sure nothing snuck in overnight. Main reason not to do that is for fear of aborting a weak economy and especially aborting a weak housing market. But we're in this totally weird deal where the outside world is an absolute wreck. I mean, all of it. Europe, Japan, and China, all of them. And the fear is in every screen of every foreign market, and cash pouring into the United States, which is pushing down long-term interest rates, which is what my racket depends on, the mortgage business, the housing business. So my hunch is that the Fed is going to sound more and more hawkish, despite the condition of the rest of the world, despite the downward pressure on inflation from gasoline prices here. And we are going to be protected by the flood of cash that comes in from overseas to push bond yields down. I have it figured out. It's okay. Merry Christmas. Thank you all.